Everyone talks about market structure, but the majority of the time, they get it completely wrong. And the reason is simple. They're looking at every tiny move like it matters. They're mapping highs and lows on every candle. They're confusing themselves with complexity when the entire concept is built on something ridiculously straightforward. See, structure isn't about drawing lines on every swing. It's about understanding how the market actually moves. So in this video, I'm breaking down the full framework of market structure, step by step. No assumptions, no skipping the basics. Just the exact process I use to map structure, identify valid trades, and stack probability in my favor. You're going to learn how to read structure as waves instead of noise. You're going to see how substructure fits inside swing structure, and you're going to walk away with a repeatable system that works on any asset, any time frame, any market condition. Stick with me through the whole thing, because by the end of this, you'll know more about market structure than 90% of people who've been trading for years. Let's get into it. All right, let's start from the foundation. Market structure is just the way the market moves. That's it. It's not some mystical concept. It's literally the pattern of how price appreciates and depreciates over time. And when you boil it down, there are three phases: uptrends, downtrends, and consolidation. Uptrends are where we buy. Downtrends are where we sell. Consolidation is where we stay out. Simple as that. The mistake most people make is that they try to trade everything. They see a little push-up during a downtrend and think it's a reversal. They see a pullback in an uptrend and panic. They're constantly reacting instead of reading. So before we go any further, lock this in. Your job isn't to trade every move. Your job is to identify which phase the market is in and then trade in the direction of that phase. If you're in an uptrend, you're looking for buying opportunities. If you're in a downtrend, you're looking for selling opportunities. If you're in consolidation, you wait. That's the game. So let's dig into how trends actually form. During a trending move, we get two repeating phases: impulses and corrections. Impulse moves are pro-trend moves. They're the big pushes in the direction of the overall trend. Corrections are pullback moves. They're the retracements that happen when the market pauses to find better pricing before continuing. Why does this happen? Because the market is an auction. Think about it like this. In an uptrend, buyers want to buy, but they're not always happy paying the current price. So buying slows down. The market eases back. Price drops slightly until it hits a level where buyers are willing to step in again. When a good buying price is met, people buy, and the next impulse starts. Same thing in reverse for downtrends. Sellers wait for a better price to sell. The market rallies slightly. Then, when price reaches a level sellers are comfortable with, they step in and push it lower. This is why pullbacks happen. It's not random. It's not noise. It's the natural rhythm of supply and demand playing out in real time. And once you understand that rhythm, you can start predicting where the market is likely to go next. You might ask, if it's that simple, why do people struggle to understand it? I will give you two reasons. First, they're reading highs and lows incorrectly. They're marking every single swing, every tiny movement, every wick. And because markets move across different time frames, they get caught up looking at the wrong lows and the wrong highs. They lose sight of the bigger picture. They're constantly confused because they're treating every small move like it's significant. That's a fast track to bad trades and poor decision-making. To fix these problems, you must view structure as waves. Instead of looking at every small up and down move, look at structure in big phases. Think of the market as moving in waves, large impulses and corrections that form the skeleton of the trend. This keeps you in tune with the overall trend direction instead of getting lost in every small push. You're not ignoring the small moves. You're just not letting them dictate your understanding of the bigger picture. You're zooming out. You're seeing the forest, not just the trees. And that shift in perspective, that's what separates beginners from traders who actually make consistent money. Which brings me to the second issue people have. They don't understand the difference between swing structure and substructure. Let me explain. The waves we just talked about, the big impulses and corrections, those are swing structure. The small moves that happen within those waves are the substructure. Swing structure is the larger trend. It's the primary direction the market is moving. Substructure is the smaller, valid trends that happen inside of that larger move. And here's what's important. It is possible to take advantage of these smaller substructure moves because they are valid trends inside of the larger trend itself. That means even if the higher time frame is bullish, there are smaller, bearish opportunities happening within the pullbacks. But, and this is critical, if you're trading substructure against the higher time frame, you need to manage that trade differently. You need to protect yourself. You need to use break-even stops, trailing stops, or some other method to lock in profit and guard against reversals. Because the higher time frame trend is stronger, and if it reasserts itself, your substructure trade could get wiped out. So yes, you can trade substructure, but you do it with awareness, you do it with discipline, and you do it with proper risk management. All right, let's put this into practice. I'm going to walk you through exactly how to map structure on a real chart. Here we are in the 1 hour time frame. Now we can see we had a trend shift here, shifting us into an uptrend. Now we're going to map the swing structure. So in terms of the swing structure, we are seeing multiple breaks of structure, which are taking us to the upside. And we can also clearly see the market is making higher lows along the way. So this is clearly an uptrend. It's not a downtrend. Now, how exactly do we mark the swing structure? Are we going to consider every tiny little nuance in the trend? No, we are not. We are going to move with the bigger picture and view this as waves. So there we have wave 1. That's the impulse. Wave 2, that's a correction. Wave 3 is the next impulse. Wave 4 is the correction. Wave 5 is another impulse. Wave 6 is a correction. And then wave 7 would lead us all the way up towards this point just here. Because this really is not too much of a viable break of structure, being just a wick, and this would actually signify the larger wave. So you've seen there how we mark out structure as a wave, instead of actually trying to look at every single little move. Now, sometimes, lots of beginners, and when they're in their early days, they're actually looking at every single little movement like this, and considering this the larger trend direction, and then getting confused because they're like, well, the market's changing direction every few seconds. How am I supposed to keep up with this? Well, in reality, we're not. We just want to move with the big picture. We don't need to worry about little candle movements like this and the intricacies of each small move. What we need to do is focus on that big picture. Remember earlier I mentioned the concept of substructure, the smaller trends inside of the larger trend? Well, we can actually trade these as their very own trends. So breaking down structure even further in this example, we can start to look for the smaller opportunities inside of the bigger move. So now working with the same piece of structure that we just looked at in that structure mapping example, we are going to look at the substructure and swing structure of the market. So let's mark on the swing structure. And now let's mark the substructure. The swing structure is the impulse moves, and the substructure is the correction moves, the pullbacks, okay? So as you can see, although the larger trend is bullish, we do see smaller bearish opportunities happening within. We can see that we have a valid downtrend actually happening inside of the correction. This is where we can take advantage of the substructure to take trades that are counter to the higher time frame swing trend, but entirely valid using a lower time frame. So for example, here inside the hourly, we could drop to the 15-minute and look for 15-minute bearish opportunities throughout this structure. So for the sake of example, I'm going to dig into this movement here and show you where the substructure opportunity came in. Okay, so using this piece of price action, we can see we have the impulsive movement. This was the larger hourly move. And now we are looking for a corrective move. Now, of course, we do not want to execute upon any trades until the market sentiment has shifted. So, being on the 15-minute, we would want to see a 15-minute break in structure, which would come at this level. Now, if we get that, all good. We can go for a substructure move. If we don't get that, that's fine. We will just be continuing with the higher time frame swing structure. Now, as you can see, we've just broken the trend here by forming a lower low with a body closure. So what we could do now is look for opportunities to sell through this valid 15-minute trend. So why are we doing this if we know that the high time frame is bullish? Well, the reason for that is simply because we have a valid lower time frame trend. So this actually comes back to the fractal nature of the market. Now, the market moves in a way where the same patterns are repeated across multiple time frames, and this is a great example of that. We can actually see a valid hourly trend, but we can also go and see a valid 15-minute trend, both of which may provide valid trades. Now, when you're taking a trade like this, because we're moving against the higher time frame, even though we're moving in a valid 15-minute trend here, we do want to make sure we are employing a break-even strategy, or trailing stops, or doing something that will save us when the market doesn't reach our targets. Because obviously, if the high time frame trend is bullish, the high time frame trend has more weight. That means that we're not always going to get our targets filled, therefore meaning sometimes our trades may reverse after moving in profit. So we need to make sure we're protected from that, and in an ideal world, locking something in as well through trailing stops. So as you can see, this trade has now played out, and we would have actually added here 3.6R that we wouldn't have seen if we weren't using this substructure swing structure methodology. Now, you could obviously refine this to your strategy, or execute the trade however you want. The concept I'm trying to show you today is just the trend. So you can see that both the bigger swing structure and the smaller substructure can provide opportunities for trades. The hard part is differentiating what is swing structure and what is substructure, and the best way to do that is by looking at the market as waves. The next rule you should consider is how far you should look to take your substructure trades before taking profit. You shouldn't try to extend substructure moves past the highs or lows of the swing structure moves. So if we're in a swing uptrend and we are taking a substructure sell, we should look to take profit at or before the demand zone at the bottom of the swing structure move. This way we know if the market continues to move in the uptrending fashion, we are out of our sell move before we get destroyed. This way we capitalize on the whole pullback or correction, but we don't try to take the market too far, and instead, we keep moving with the larger swing trend. If you enjoyed that, hit the like button and subscribe to the channel.